if they increase interest rates, it's going to kill Wall Street. Wall Street will be, gapped down, and these guys, their pensions will be affected too, and they wouldn't want to see that, would they? What they will do is they'll talk the markets, some sort of psychotherapist. They're going to sweet talk the markets and talk about how it's going to be okay, and they're going to do whatever it takes. But ultimately, they're in a very difficult place.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Stephen Flood, CEO of GoldCore. How are you today, Stephen?
I'm really great, Tom. So good to be here.
Excellent to have you. So, as a former Wall Street equity trader and fintech expert, how do you bring those skill sets into the CEO role at GoldCore?
Well, God, in so many ways. I mean, we built this company up on a really, really strong technology backbone from first principles, which is really kind of how do we, provide a really powerful, segregated, allocated storage program for the best possible value. We were talking off air beforehand, and I was saying to you, basically, when I first started out in Bankers Trust many years ago, we had a new general ledger system, and the whole idea was to build a mnemonics-based system and get rid of account numbers, and we did that successfully. You borrowed off that technology to build the storage backbone for GoldCore, and what that allowed us to do is to have a really powerful segregated allocated system whereby every bar, every coin, it has an owner. It's either GoldCore or the client, and when a transaction happens, it shifts over. It has a location, which is the storage vault. We have 11 of them around the world now in North America, but our biggest one is in Zurich. And then it has a destination where it needs to get to, either the client's house address or it needs to be in a different vault. And essentially, depending on those values, the system, the asset in the system kind of shouts out and says, I need to be moved, I need to be shipped, I need to be moved over to another owner. And based on that, we're able to manage, about 300 million in assets very, very effectively with very little error rate at all. And it's built for storage, segregated, allocated. The reason we're segregated, allocated is because we want to reduce that proximity, that ownership proximity. So the asset stays on the client's balance sheet, it's not on our balance sheet, and we get things settled. Recently, we were able to settle, I think it was an $800,000 kilobar order in Zurich for a very big European client. And we were able to settle it within 2 hours and 15 minutes. So that was bars on the shelf, serial numbers updated in our system. And most importantly, the serial numbers were updated and allocated to the client's account in the vaulting company's system as well. So the client logged in, it was in Loomis in this case, and was able to see all his bars listed there on their system, which was just incredible.
Mm-hmm. So, Stephen, we've spoken before on the show about how to store metals if you don't want to have them in your home. So from your perspective, what is the proper way to store bullion within a vault? Like, talk to us about the importance of that allocated, segregated model.
Well, there's a lot of ways of buying gold these days. There's an awful lot of providers out there, and some of them are very, very good, run by good people. Some of them are less so. So you have to be careful. I think that you have to consider your gold as a real physical asset. It's not a proxy. So don't buy a derivative. Whatever you buy, it has to be physically there and backed and on a shelf. And as I say, segregated means that it's like having your car parked in a car garage that we manage. It's still your car. It's not our car to drive around the block or sell it to somebody else or rent it out. And we can't touch that asset. And it's not on our balance sheet, as I said before. So I think you have to have it properly stored. We use a system called bailment, which is an old English legal term, which means it's your asset minded by us. And I think that's very important. So always go segregated, allocated, avoid proxies or anything like that, paper gold or whatever they are. And I think if you have a large sum of gold and silver, probably best pay for storage. Make sure it's insured. Make sure they do audits. We do an audit every year. We have insurance certificates from Lloyd's of London, which are sent to every client once a year. And clients can go and visit their gold as well in certain vaults. Other vaults don't allow it. But if you do that, you know that should the worst come to pass, that you can move your asset out into a different vault, a different system, a different jurisdiction, and it's a physical, real, tangible asset. And I think that's important.
What are some important ideas to remember for investors not to get scalped when buying gold or silver?
Really important. Great question. I don't know if you know this, but we actually opened up an office in California just there a few months ago. And one of the things we found when we were doing our market research is that there's a lot of dealers will put out, too good to be true type offers, like, buy this metal at spot price. And you call up and you go, hey, I'd like to buy that offer. And they go, well, it's all sold out, because they only had 10 of them on the shelf, and they have 1,000 calls coming in. And then what happens is they shift them into other products with higher premiums, and they have a really, really sophisticated sales pitch. That's kind of like a loss leader type model, bait and switch type model, and it's not right at all. It's unethical. So you have to be careful. So if they're advertising, they have huge advertising budgets, and you're seeing like really fancy advertisements on TV, probably you're going to be paying a big premium in order for them to make enough money to pay for that advertising. That's the way I look at it. So it's best to kind of go with an established dealer, that actually is good for their word, and whatever they sell, they actually provide. I would avoid any kind of numismatics unless you know what you're about. Buying brand new Eagles, having them graded, and they're 2021s or 2022s is ridiculous. We don't do anything like that at all. Our whole purpose is basically to provide the lowest possible premium. We want to keep you as a customer. We want you to get the most value. You want your dollar to go as far as possible. None of the people who you talk to at GoldCore actually paid a sales commission. So if it doesn't fit the customer and we get a bad review because we missold something, all hell breaks loose here. Our team are absolutely and utterly reminded every day that we want the customer to have a good outcome, because we want to win their business, and we want to win their friends' business and their family's business. Mm-hmm. And that's how we grow, maybe a little bit slowly, but we grow, very, very assuredly and very client friendly. And so, so I would say that there are certain dealers you could go to buy numismatics, which are sold on the basis that they go up faster than gold prices when things are rising. But just be very careful who you buy from. And if you need to know any more who to go to, come to me, and I'll put you in front of some really good, reputable dealers.
What did you mean when you said grading Silver Eagles?
Well, I think they're actually gold Eagles. So there are some companies out there who will take a batch of 500 gold Eagles, send them to a grading service, have them slabbed, and then sell them for a huge premium over the price that they'd normally be sold for. If you come to me with a graded 2021 gold Eagle, I'm going to pay you exactly what I'd pay you if it was not graded. I don't care if it's graded. I buy it on the basis of the bullion value. That's what the value of it is. Don't pay over.
What does graded mean, Stephen?
Yeah, it means it's perfect. It's mint condition. Mm-hmm. It hasn't been touched. There's no scratches or anything on it. And basically, some dealers will pay $20 to get something graded and then add another $150 onto the price. Right. It doesn't make any sense.
Mm-hmm. So how have premiums reacted so far this year? We've seen, a lot of up and down, geopolitically. So how has the demand for metals affected premiums so far this year?
Massively. I mean, there's huge demand in the US, all on the back of the inflation story that's really biting home. So a lot of investors are acquiring gold as part of their diversified portfolio. Hardly anybody in the marketplace buys gold. The broader consumer marketplace. I think it's like 1.5% of the population have actually purchased physical precious metals. It's really, really low. I think that's going to increase dramatically, and more people are going to look at it, because let's face it, the dollar is losing massive amount of value. There's at 7% inflation, which is the official number. It's probably arguably twice that. If you think about it. At that 7%, if you look at the old rule of 72, I don't know if you've come across this. It's like the rule of 72 means take an inflation number, divide it into the number 72, you get 10. That's the number of years that it'll take for your money to have in value, buying power. So at 7%, you're literally your pension is, if it's all in cash, is going to be worth half of what it is in 10 years' time. It's a really serious matter, especially when you think about it, that you pay taxes on that money, those savings, those pensions, those investments, you've worked hard for it. And then suddenly, by reason of some central banker who's not elected, and remember that they're not elected, these people are masters of the universe, They can print money, bid up the price of stocks and other assets, enrich themselves in the process. But actually what they're doing is they're devaluing your money.
Mm-hmm. Well, it's interesting when we think about, let's say, the incentives of the Fed. Do you think that its mandates are somewhat opposed?
Oh, completely. If you actually go into the, I think it's the Federal Reserve Act, there is actually a segment in there. I was actually reading this the other day that's explicitly states that they're not allowed to hold positions inside the banks, which they are regulating, because back then they were pretty much focused on banks. Their remit didn't affect the broader economy in the ways it does today. But right now, what you have is, and you've seen the stories yourself, where they're trading ahead of the markets. They're actually buying and selling their own positions, and then moving the markets based on their news cycle. I think it's an awful state of affairs, and I think it just shows that there's huge questions to be asked and answered with that system. So yeah, the Federal Reserve has an awful lot to answer for.
So on the topic of incentives as well, is there any political appetite to actually cut interest rates and take the pain that it looks like is needed to help cleanse some of the excesses that are consequence of this low interest rate and QE world that it has created?
No, I think is there an appetite to cut interest rates? I think they would if they could, but if they do, they're going to drive inflation higher. That's going to kill the economy and send the economy into a tailspin where consumers go, my earnings are now less than my cost of living. I'm not going to buy that car. I'm not going to go on a holiday. And when that mindset sets in, it's very difficult to stop it. So the first thing you need to do is douse that inflationary monster with higher interest rates and take the kind of the heat out of the market. That's the only real thing you can do. Mm-hmm. So if they increase interest rates, anything in a meaningful way, they're going to kill the economy as well, which is highly leveraged. It's never been more leveraged. Even on a global basis, the leverage is extraordinary. I think in the last financial crisis, it was around 240% debt to GDP globally. Now it's looking at about 340%, which is extraordinary. So if they increase interest rates, it's going to kill Wall Street. Wall Street will be, gapped down, and their own these guys, their pensions will be affected too, and they wouldn't want to see that, would they? So I think they're in a very difficult place. What they will do is they'll talk the markets like some sort of psychotherapist. They're going to sweet talk the markets and talk about how it's going to be okay, and they're going to do whatever it takes. But ultimately, they're in a very difficult place. They could let inflation bubble away, maybe 5-6%, and hopefully garner some sort of growth, knowing the market's backed, and then burn away that debt burden over time. That's the only way I can see them getting out of this. But to be honest, the markets have had such a rip-roaring ride, going from, I think the S&P was 666, which is an interesting number of the beast, at the low point, and it's rallied all the way up into the high 4,000s. So it's unbelievable. But to be honest, the real story behind this is, like, if you look at the U.S. economy. I love this app you can get called the Debt Clock. I don't know if you've ever gotten it. It's absolutely fantastic, and it shows that the average wage in America back in the year 2000 was around $31,000 a year. Today, 22 years later, it's gone up to $35,000. Okay, so the average worker in America has gotten a $4,000 increase in his pay in 22 years. But if you look at the average car, it's gone from $22,000 to $47,000, which is incredible. And if you look at the average house, it's gone from $162,000 to almost $400,000. So there's an impoverishment going on at the heart of America. People are losing traction in this economy. Not all boats are rising together. And I think when that happens, you have all the ingredients for social unrest and extreme politics. People will vote for the extreme. The guy who's going to get up there, or the girl who lies and says, I'm going to deliver everything. I'm the savior. I'll solve all your problems. Don't ask any hard questions. Give me your liberty and I will solve your problems. That's what happens when people are desperate. And that's what they're playing with.
Mm-hmm. So as we talk about this inflationary environment, what happens to gold in a deflationary environment? Does gold do well, in your opinion, in both of these? Yeah, I mean, it depends on the nature of the deflation and the nature of the inflation. Right now, gold prices have not really reacted to this inflation shock that we're seeing. Mm-hmm. It has slowly but surely moved up in the last year or two as the pressures were increasing. But what I'm waiting for is when reality hits High Street,
when inflation begins to bite and consumer trends shift. So from an increase in borrowing, in liquidity, in consumer spending, in credit cards, when people start realizing that the future is uncertain, they start tightening their belts. That's when gold prices shift en masse. When a lot of people, not that 1.5% of people who buy gold today, but when 10.5% of people start to look at gold, or 20%, when the taxi driver is asking you, where do you buy your gold? When that happens, you could see gold prices absolutely skyrocketing relative to the dollar, relative to other assets, which are then falling. And it could go parabolic. I mean, just remember in 1970s what happened, and there will be a time that they maybe pair back in your gold position as well, and your silver. Silver will probably go up twice as fast as gold and fall twice as fast. But it's really setting up for the perfect storm for bullion.
Mm-hmm. So what do you make of the price action of gold and silver today? Of course, we're speaking on the morning of Thursday, February 24th, and gold got up as high as 1974 this morning before giving back all of its gains and more. So do you expect this type of volatility when we're facing this type of international turmoil?
Oh yeah. Well, the volatility came in when the COMEX opened, and the COMEX just slammed the price down. So some hidden hand suddenly decided to sell, an insane amount of gold right into a risk off event globally as Russia moved into Ukraine, and we had war in Europe for the first time in 77 years, and the gold price gets sold off just when COMEX opened. So it's a real tail wagging the dog. The physical market is absolutely on fire. It's great. It's fantastic. People are buying gold and shifting into it, which is great for them. And the COMEX, which is highly leveraged institutional players. Maybe I'm not going to suggest, but there might be some manipulation at work. It certainly seems that way.
Trying to protect some of their short hedges.
Maybe covering some shorts. I don't know, but also you don't want to see the gold prices rocketing higher and sending a signal to the populace that maybe things aren't as calm, and those in control maybe are not in control, and maybe they don't have a map and they don't know what they're doing, which is, I think, happening more often than not. And so they don't want to see gold prices skyrocketing on a day. They want to kind of neutralize that move. Mm-hmm. That's just a theory I have, by the way.
Excellent. So, Stephen, what have historically been some of the effects of war on silver prices?
Well, I mean, I think silver tends to track gold, and it has basically twice the volatility. So war is obviously, it depends on the type of war. If it's a war where energy prices are going to be affected, that would have a massive knock-on effect. I always say that the precious metals complex, in gold in particular, it's like you have a frame, a picture frame, and it moves. You could look through it, there's nothing in it, but the gold's perspective shifts depending on where the risk is. So right now, interest rate yields are indicating that yields are going up, and that means that interest rates are going up, and that gold prices are holding a gold allocation looks more expensive, and that typically is bearish for gold. But gold has actually ignored completely that line and is focused on the energy disruption in Europe, and has rallied as a result of the risk. So I think silver is also rallying as well. So it depends on the nature of the war and how systemically relevant it is. I think what we're seeing is Russia, a superpower, invading into Europe, a major country of 45 million people. That's a huge event, and that changes the entire energy complex. And it creates huge problems for Europe, and their principles, and exactly what they're going to do about this threat and what it means for Europe in the future.
Mm-hmm. So does this kind of action just strengthen the long-term case for owning gold to you?
Yeah, I mean, it's my view that gold is not a productive asset. Let's be straight. It doesn't actually have a yield. It doesn't have to pay a rent. It actually costs you money to store. But it's more valuable for what it is not than what it is. So, if you want to make money with investments, buy a productive asset, buy a stock with a dividend or has a future cash flow, buy a house with renters, or a bond with coupons. But don't buy gold, because it's not going to pay you anything. It's going to cost you money. But the way it fits into a portfolio is it's a form of money par excellence. It's always going to be available and can use in transactions right across time, right across cultures. And it sits there, that 5 or 10%. And what happens is psychologically, as an investor, if you see a 50% gap down in the equity markets and you're freaking out and your neighbors are freaking out, but if you're the guy on that street, and it's going down 50%, and what you're thinking as an investor, normally as a human, it's going to go down another 50%, and I'm going to get tapped out. I'm going to get a margin call. I have no money left, and you're really having a hard time of it. But if you have that gold allocation in your portfolio, it's going to start going from 10% to 20 or 30%. It'll take the sting out of that correction, and it'll settle you down as an investor, and it'll allow you to pick up bargains. And you won't look at this as a washout. You look at it as an opportunity to buy cheaply, as other people overreact. So to me, the function of gold is to protect you and your mind, so that you don't flip out and you don't sell at the wrong time, and you actually get to acquire gold. So it's financial insurance. The other major benefit is it makes you financially sovereign. So by having that physical gold there sitting in your vault or sitting in Zurich, wherever it is, you have a form of money that can't be destroyed and can't go to zero. And that is really comforting, especially if you have a family and you're looking at longer economic cycles. That's really, really comforting.
Mm-hmm. So is gold becoming less correlated to world markets? And does that count as another feather in gold's cap?
Yeah, I think it depends on where the mode of the market. So if things are calm and the markets are plodding along, gold tends to track other markets and it tracks inflation. Quite boring. It doesn't really, have any fireworks. But when things go into, more than one standard deviation, 2 standard deviations, or 3 standard deviations, suddenly there's volatility, and gold starts reacting to that risk as people go from assets that are productive and called risk-on assets into risk-off assets. So things like the dollar, the yen, gold, they all start appreciating, sometimes treasuries as well. And that's really when it comes into its own. But you will find that if the economic cycle shifts from total washout and economic collapse, you will find gold will get sold off in that environment as people drop it in favor of other more productive assets. But we think over the long term, if you look at gold in almost every currency, over the last since 2007, gold in dollars is up about 7.9% annualized. In the euros, it's up 8.8, and in GBP, it's up 10.7. So that's incredible. That's an annualized return over those years. And I think since the 1970s, it's kept up with the S&P 500, which is ridiculous because if you think about it, the S&P 500 is the best companies in the world, working their hardest with the smartest people, and yet an inanimate object like gold has actually kept track with it. I mean, what does that say? It's I think it's a monetary phenomena as well in terms of printing of money.
Mm-hmm. So when we think about the non-correlated nature of assets to gold, we saw a perfect divergence between gold and Bitcoin yesterday. So what is your view on crypto technology and Bitcoin's role in a portfolio?
Well, Bitcoin's role in a portfolio is should be somewhere between 0 and 0.1 or something like that. I have a bit of Bitcoin. I own it because I know I'm not. I'm a weak, normal human being, and if Bitcoin was to go to $1 million and I had an opportunity to buy it at like 10,000, I would never forgive myself, even though I wouldn't understand how it got to $1 million. So you put a few $100s in there, and it allows you to take your mind off something that's not really is not an investment and doesn't actually have any kind of investment thesis, and focus on what you really can know and know about, which is the rest of the world. My belief is that blockchain, which underpins Bitcoin, is probably a 1 in 1,000 year technology. It really is absolutely fundamentally going to change every part of the world economy and every part of our lives. When it goes into every economic vertical, it's going to change everything. I've done a lot of work on this and a lot of work in how blockchain can empower the bullion market in particular to produce much better outcomes for clients and empower clients. But in terms of Bitcoin and crypto, I do think there's a huge amount of speculators. When the futures markets got involved in with a Bitcoin contract, I think it was game up for the system. Now it's just being pushed around by speculators and special interests. And then you also have a group of people who are kind of a libertarian bent. They look at this as being like the people's currency. It's going to overthrow the dollar and it's going to empower people. I think they're deluded in thinking that these governments are never going to give up control over currencies, because currencies and their control underpins their own power base. They control us by interest rates. They control us by liquidity. They control us through taxes. And you're not going to give up that power to Bitcoin at all, ever. So no, I don't think it makes a whole lot of sense. And I think it's full of speculators and people who are just kind of fanatical about it. And I don't think it doesn't even compare well with other cryptocurrencies which actually have a utility, like Ethereum and the like Ripple. These actually have a purpose. They actually have a utility. So no, it's the first one out, and it's fantastic. It's a thought experiment. I think it's brilliant in that regard to see how it's been adopted and used. But you don't buy a pizza, you don't pay for a taxi with it, and it has no yield.
Well, it's interesting, in a time of, quote unquote crisis at this point, we're seeing how, let's say, the store of value case for it, right?
Well, yeah, that was one thing was hanging on to. It was like, oh, it's digital gold. It'll be around here. There's 21 million of these units, and that's all there'll ever be. Well, that's, excuse my French, horse shit, because 21 million units could be divided via one single derivative contract into 21 billion units if you wanted to. I could share a single unit and have a contract that shares it out to 1,000 other people. It doesn't actually make any sense at all. So no, it's highly correlated with the Nasdaq. Its correlation is now 0.61. So if the Nasdaq moves by 10, the Bitcoin will move by 6.1. So gold is negatively correlated to the Nasdaq because it's a safe haven asset. Bitcoin is not at all. So it just lost in the last few months with the fireworks in the market. It's lost its last reason to own it. Because it failed as a currency, it's failed as a store of value, as a unit of measure, and its volatility is insane. It really is. And you look at these guys on Twitter, and you look at them and you read what they say, and they're fanatical about it, but they can't give you any real hard reasons to own it. It makes no sense.
Excellent, Stephen. Well, I appreciate getting your view on these topics here. Before we wrap up, do you have anything else you'd like to add?
Just one thing. We have our office in California, which we're really excited about, and we've been around for 18 years. We're at GoldCore.com, obviously, if you want to be a client. But we created a guide with 5 points that every new gold buyer needs to be aware of before they go into the market. And we created a special website called goldintheusa.com. So goldintheusa.com. It's a free guide. It doesn't cost you anything. You don't have to be a client of GoldCore or anything like that. But it's 18 years of experience boiled into 5 major points, and it will help you navigate and hopefully get better outcomes as you go into the gold market. Because I think a lot of people are going to be going into the gold market soon.
And of course, you guys are available on Twitter at GoldCore as well.
Yeah, that's it. We're available on Twitter, and you can reach out to us anytime you want.
Excellent, Stephen. Thanks so much for your time today.
That was great, Tom. Thank you so much for your time.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.